fams, how are you doing today? I believe you are doing great. Welcome back to Blessed Institute, the institute that prepare you for your professional examinations. All right, today, by the special grace of God, we are going to start the group account. This is one of the topic that the examiner used to test either in skills level or in professional level. Therefore, there is a need for you to pay rapt attention to this particular topic and as well as other topic as well. Yes. All right. So we want to talk about group account. Let me just explain what group account is. There are many companies that they have different subsidiary. When they are talking about subsidiary, these are the company that is either wholly owned or partially owned by the parent company. And when we're talking about parent company, who are the parent company? Parent company are those companies that have a significant interest in another company. They have significant interest in another company. Most of the time, if it will be subsidiary, the parent company must have 50% above, 50% interest in that particular company. Before that company can be called its subsidiary, it must have 50% interest in that company. That means the share of that company, 50% of the share of that company is being owned by another company. For example, let's say company A and company B now. Then company A purchase 50% or let's say 60% share of company B. Automatically, company A is the parent company while company B is the subsidiary company. If it purchase say 20% to 49%, it is not a subsidiary. It is just an investment in associates. Are you getting like that? Why it is if it is just 1% to 90%, that is just an ordinary investment in such company. Do you get like that? So there are many companies like that that yes, they have different subsidiaries, but there is a particular company that is sponsoring that has purchased or acquired that the share of that subsidiary company. For example, now you'll be hearing Dangote Group. Are you getting me now? So it is a group, the Dangote Group, they have a parent company and they might have um, acquired a significant interest of other companies. Do you get like that? Other companies. So other companies are subsidiary to them. So we have parent company. Those are the terminologies you must take note of. Parent company. This is the company that acquire a significant interest in another company. Why subsidiary? It is the company that the parent company actually was actually acquired. So while considering this particular topic, you will be needing the knowledge of IS 27, that is separate financial statement, IS 28, investment in associates, IS 3 business combination, IFRS 3 business combination, IS 10, that is consolidated financial statement, IFRS 11, IFRS 10, IFRS 11 joint arrangements. So you must know at least you must have the knowledge of this standard for you to be able to um, um, solve questions on group accounts. I believe you are getting me right. All right. So let us try to define some terminologies. So what is group? Group Group, a parent and its subsidiary. That's a very IFRS 10 business combination. Group means the parent and the subsidiary. Group means the parent and the subsidiary. Then, what is the meaning of consolidated financial statement? The financial statement of the parent company and its subsidiary. That is the consolidated financial statement. When you bring the financial statement of parent and that of subsidiary, you bring it together, you consolidate it. Are you getting that? Let's say parent uh, parent A has asset of 20 million and parent B have, let's say a parent A have PP of 20 million. Parent B, I mean subsidiary of that parent A has let's say PPE, property plan agreement of 10 million. Then you add 20 million plus 10 million together. You present it in a single financial statement. That is what we call consolidated financial statement. Then we move to Parent, an entity that control one or more subsidiary is referred to as parent. An entity that control one or more subsidiaries. We have subsidiaries, an entity that is being controlled by other entity. IFRS 10 take care of all these things. That is, we are seeing them writing IFRS 10 at the front. All right, we have um we have control. An investor control an investee when the investor is exposed to or has right to variable return from its involvement with the investee and has ability to affect those returns through its power over the investees. All right, what is associate? An entity over an investor has significant influence and which is neither a subsidiary nor an interest in a joint venture. That is associate. Then we have significant interest. It is a power. The significant interest means the power to participate in the financial and operating policy decision of an investee, but not control or joint control over the over those policies. Then we have power, the existing right that gives the current ability to direct the relevant activities of the investee. So we have reacquisition reserves or profit. These are the aggregate reserve or profit earned by the subsidiary company before being acquired by the parent. When we say that reacquisition, retained earning of reacquisition reserve, these are the reserve that is being or earned that has been earned by the company before it was actually acquired. We have post acquisition reserve or profit. These are the aggregated reserve or profit earned by the subsidiary company after being acquired. Then we have type of subsidiary. We have wholly owned subsidiary. This is subsidiary which a parent company has a controlling interest of 100%. So when the parent company has an interest of 100% in a particular subsidiary, then we refer to that subsidiary as wholly owned subsidiary. We also have partly owned subsidiary from the word partly now. This is a subsidiary which the parent company has controlling interest of more than 50% but less than 100%. That is partly owned. Don't forget, wholly owned. The parent company own all the shares in that particular subsidiary. While partly owned subsidiary is when the parent company own 50% or more than 50% in a particular company, but they don't own it all. They don't own up to 100% of the share capital of that company. Then we have fellow subsidiary. Two or more entity will be regarded as fellow subsidiary if they are controlled by the same parent company. For example, now let's say company A has significant interest of 50% upward in country B, also has significant controlling interest of 50% upward in control C. That means control B and C, they are fellow subsidiary. Are you getting like that? They are fellow subsidiary. Then we have subsidiary. An entity is treated as subsidiary of another entity if it is a subsidiary to an entity which is also a subsidiary to another. The example of these ones, when A purchase B, B also now purchase C. Are you getting now? That is an example of subsidiary. C is a subsidiary of B, while B is a what? Is a subsidiary of A. I believe you are getting me right. We have foreign subsidiary. This is a subsidiary which is situated in a country other than the country of its parent company. Let's say company A. Let's say parent company A, which is the parent, is in Nigeria, while country B, which is being owned by control A, or company A rather, which control A has more than 50% significant interest in control B, and that control B is not in Nigeria. That is a foreign subsidiary. All right, all right. Because of our time, let us go to determine the ownership interest and criteria in an invest company. Um, so they said A has 60% of equity share of B. If A has 60% of equity share in B, that means A is what? A is subsidiary. Sorry, A is parent while B is subsidiary, because A has 60%, that is more than 50, that's more than 50 in what? In B. That means B is a subsidiary while A is the parent. We have A has 45% of equity. A has 45% of the equity share of B. If that is the case, that means B is an associate. B is an associate. You know, I gave you the example. I gave you the table the right time. I said that 1 to 19 is just an investment. 20 to 49 is an investment in associates. Why 50 to 100 is a subsidiary. Is a subsidiary. Is a subsidiary. Okay, more than 50 rather. Greater than 50 to 100 is a subsidiary. Why 50 itself? If it is 50 itself, 50 itself is a what? Is a is a joint venture. It's a joint venture. So that is what they are trying to explain here. So because of our time, let's just move. Let's just move to criteria table. I've already explained this one. Already explained this one. So prepare principle for preparing consolidated statement of financial position. What are the principles? One, the share capital that will be shown in the consolidated statement of financial position should be the share capital of the parent company only. So when you are preparing your consolidated financial statement, the share capital that will be what that will be shown will be that of what? That of parent company only. Why? Because you have already acquired the what? You have already acquired the share capital of the subsidiary. So there is no need of bringing it back. Do you get? Also, two, the reserve retained earning and other reserve that will be shown in the consolidated statement of financial position will be the parent company reserve plus the parent company portion in the post-acquisition reserve of the subsidiary. So if it is now reserved now, or if it is reserved, that is retained any another reserve, the portion that will be shown in the consolidated statement of financial position is that of parent company plus the portion that the parent company is what is acquiring in the subsidiary. In the subsidiary. All right. Three, the non-controlling interest. Non-controlling interest. The non-controlling interest that will be shown in the consolidated statement of financial position will be the NCI portion in the aggregated or total of the subsidiary net asset capital. We have goodwill on acquisition. This is the difference between purchase consideration and the fair value of identified net asset of the subsidiary. Unrealized profit on assets should be eliminated. Unrealized profit on asset should be eliminated. All intercompany or intracompany balance should be eliminated. Subject to the above adjustment, consolidated assets will now be parent company asset plus subsidiary asset, plus or minus adjustment. That is the what? The adjustment you are going to make now will be parent company asset, subsidiary asset plus or minus adjustment. Then consolidated liability will now be parent company liability plus subsidiary liability plus or minus adjustment. So we have positive goodwill. Positive goodwill is a situation whereby the fair value of net asset of the DOA is actually what? Is actually lesser than the purchase consideration. For instance, now let's say that the company want to purchase the net worth of an asset. The net worth of the subsidiary is 4 million, and then the company paid 5 million to purchase what? To purchase that subsidiary. Are you getting that? That means to purchase that subsidiary, if it is wholly owned now, you will see that the purchase consideration, the amount they are paying to purchase that asset, to purchase that company, is actually more than the value of that company, with what the difference of 1 million. That 1 million is what we refer to as positive goodwill. Positive goodwill. And the treatment is that you are going to take it as a line item on the face of your consolidated statement of financial position. That is after your PPE, you just bring your goodwill. All right. Don't forget that purchase consideration is a combination of what? Investment in subsidiary plus the NCI, plus the NCI, plus the NCI. Yes, yes. So But we can also have negative goodwill. That is when the purchase consideration is what is actually lesser than the worth of the company, than the value of the company. Let's say the value of the company is 5 million, and the purchase consideration that was paid to purchase that particular company, to acquire that particular company, was actually 4 million. The value was 5 million, while the purchase consideration paid was 4 million. That means there is a shortage of 1 million. That 1 million is what we refer to as negative goodwill. Negative goodwill. And the treatment is that we are going to add it to the retained earning. Retained earning. Consolidated retained earning. I believe we get it right. All right. So what are the procedure? What are the procedures for present preparation of consolidated statement of financial position? One, determine the percentage holding. That's what the first thing you will determine. What is the percentage holding of company A in company B? What is the percentage holding? After then, you will show the group structure, percentage holding, show the group structure. After you've shown the group structure, consider relevant information that will affect the profit or loss of the parent company or subsidiary company. For calculate the adjustment DOC, that is date of consolidation. Date of consolidation is the date in which the date of consolidation is the date in which the financial statement of the parent company is being prepared. While date of acquisition is the date in which the parent company actually acquired subsidiary. Do you get? All right, all right. So we have, after you have calculated the adjustment at DOC, retained earning of the subsidiary, you then calculate the net asset, capital and reserve of the subsidiary at both date of acquisition and date of consolidation. Then 6, calculate the goodwill on acquisition. 7, calculate the value of non-controlling interest, that is the senior financial position figure. Calculate the value of consolidated retained earning. Then prepare your consolidated statement of financial position. All right. All right. Then we move to question 1. They say Prince PLC acquire 100% of the equity share of Princess PLC. Now, who is the parent company? Who is the subsidiary company now? Who is acquiring who? Yes, the Prince PLC is acquiring Princess PLC. So, and that means Prince is the parent, while Princess is the subsidiary. And that we can note here is that it is fully owned subsidiary, because Prince PLC is acquiring 100% of the subsidiary. And the date of acquisition, we could see that they said that he acquired it on 31st May 20x9, when the retained earning of the Princess PLC was 350. So the retained earning at the date of acquisition was $350,000. The following is the statement of financial position of the two companies as at 31st May 20x9. You could see that the date of acquisition and date of consolidation is the same. So in that wise now, our post-acquisition retained earning will still be like the retained earning at date of acquisition and that of date of consolidation will be the same. It will be the same. All right. All right. So they gave us this following question information, and we're asked to prepare consolidated statement of financial position of Prince PLC Group as at May 31st, 2000x9. All right, let us try to solve that. Right, we want to prepare or calculate the reserve and the reserve of the net asset of the subsidiary, net as the value of net asset of the subsidiary. So we will take what is under equity. We are going to use what is under equity, and don't forget, when I was trying to read the note to our ears, we were told that we make use of the subsidiary figure. So our equity share is what? Is 600,000, share premium 450, and retain earning 350. So we come here, let us just put our money measurement. Let's put our money measurement for that. So we have our equity to be 600 at the date of acquisition. So at the date of consolidation, it should also be 600 because we are not given any information that maybe it's changed. So this one we gonna minus it together. DOE minus DOC, it gives us dash. Then we move to share premium. Share premium at DOA it was 450, as you can see in that question. At DOC it was also 450 because we don't have any information. So this one that's supposed to be dash, because if you subtract 450 plus minus 450, get dash. Then we have retained earning. Retained earning. Retained earnings. Retained earnings. At the date of acquisition, we have 350. At the date of consolidation, we have at the date of acquisition, we have 350. At the date of consolidation, we also have 350. If we subtract from each other, we have 0. So we don't have any other item again. We add the 3 together, it gives us 1,4. We add this one also together, it gives us 1,4. Are you getting it? That's okay. The step actually asks us to prepare group structure first. So the first thing you're supposed to do is to prepare group structure. So because let me just that okay. Group structure is just like line, like they acquire 100%, so there is no much big deal in it. Okay, so I haven't done that. Let us calculate 2 now. Calculation of goodwill. Calculation of goodwill. So we have investment in what? Investment in Princess, that is 16. And we were told that it was fully owned. That means there is no NCI, there's no non-controlling interest. They are controlling everything. There's no non-controlling interest. So our goodwill investment in Princess is what? 16. Then we have NCI. Add NCI. We don't have any NCI, so this one will dash. I haven't done that. Then we don't have any other, we just say that net asset of the subsidiary. Now we have net assets of subsidiary at DOA, or let's just say subsidiary net assets at DOA. At DOA, which is how much? The one we calculated, the 1,4. Put the 1,4 here. So the answer will be 200. We have positive goodwill because your purchase consideration, if you had investment in Princess plus NCI is 16, that means it is greater than what? The value of that asset, which happens to be 200. Alright, so let us calculate. The next step is that we should calculate consolidated retained earnings. So we come here, we say that consolidated retained earnings. consolidating earnings. Come here, last time. All right, parent retained earning now. Parent retained earnings. Parent retained earnings, which give us what? 2650. So assuming we have what? Assuming we have post acquisition now, we'll have said that we should do what? We should add share in post. But we don't have any share in post. Just let us say share in post. Share in post, which is what? 100% times 0, which will give us dash. Then this one will still be what? 2. Alright, so these are the additional information we are expected to prepare. There is no NCI. We'll have prepared the NCI as well. So let us go to the face of our what? Face of our work. Then we see that consolidated statement, consolidated statement of financial position. Consolidated statement of financial position. So we have this one here. We're going to keep the 30. The first thing on our agenda report, of course, it will be our PP and the likes. So let's go and check. Property plan agreement for parent and subsidiary is what? 1/8 and 300. No, PPE. Property plan agreement is 1/8 and 300. That will be 2/1. Alright. What else do we have? We have current assets. That is inventory 800 to 350. And 150. Trade receivable 600, 800. Trade receivable is how much? 600, 800. That is 1/4. Then we have what? Bank, 300, 900. 300, 900. Alright, fans. So this is a continuation of that statement of consolidated statement of financial position. We have PPE, we have 200. So this one is what's it called? Consolidated retained earnings. Sorry for that. So 200, we brought it here. As you can see, 200. Then inventory, we consolidate it. Receivable, we have the receivable here. As you can see, we have the total assets. Then equity and liability. So our equity now, equity. So our equity will go to, don't forget, when you are consolidating, you don't consolidate the equity of, you don't consolidate the equity of parent with the subsidiary, because the equity of the subsidiary has been acquired and you have already take that into consideration in your retained earning. Do you get? You don't consolidate the equity, ordinary share, reserve, and the likes of subsidiary. You are only going to make use of the equity of the parent company. So let us go and check the equity of parent company. Equity of parent company. As you can see, we have equity share 1,000, share premium 300, retain earning 2,650. So, but we have calculated retain earning the other time. Do you get? So we have equity share 1,000, share premium 300. So share, that is 1,000. Share premium, that is 300. And then our retained earning, consolidated retained earning now. Retained earnings. So our retained earning, come here, this 2,650 that we have calculated here. Bring it here, 2,650. You're supposed to put the work in, so I don't number this one. Maybe subsequent question I will number it 50. So we had it together. All right. Then we come to the liability part. We have non-current liabilities. That is the venture 600 plus 500 liability. So then we have current liability. Let's come and check the current liabilities we have here. We have trade payable 350 and bank overdraft 200, 100. Then we have bank overdraft. Bank overdraft is 200, 100, I think. 200, 100. That gives us 300. So if we add the three together, that should be 2, 1. Total liability now. Total liabilities is current as current, not current liability, and then current liability. So if we add it together, 1, 1 plus 700 plus 2, 1, that will give us 3, 2. On current liability plus current liability, which gives us is 050. As you can see, that the account is balanced. So that is the solution to the question. Thank you.